Hello, I'm Russ Mould, AJ Bell's Investment Director, and welcome to this multi-asset seminar in which I'm going to talk about tales of the unexpected. Now, you aficionados of 1970s and 1980s British television may well remember the television series on ITV, Roald Dahl's Tales of the Unexpected no less, which had a stellar cast of actors dotted all the way through it. But we're going to look at this from the perspective of financial markets rather than televisual history and try and look forward, not backward. But just a few quotes here, because in the end, this is a bit of a narrow perspective. I accept it's been a difficult year for everybody in many ways for unexpected reasons, but looking at it just from the narrow perspective of financial markets, it possibly could have been an awful lot worse despite these three killer phrases that I found here. So Carl Richards, the behavioural economist, risk is what's left when you think you've thought of everything else. And I think over a year ago we'd have probably thought that we had many bases covers between us for our clients. And the tail end consequences of risk, like pandemics and depressions, are what make the pages of the history books. They're all that matter, and they're all that you should think about and plan for. And that's from Morgan Housel. And then finally from Ralph Nelson Elliott, since nothing is truly definite in life, we have to look at markets through the lens of probabilities. And I think this is the key point now. That's what we're dealing with. Financial markets have priced in a pretty strong recovery. The question now is, will we get one? Will it even be stronger than expected? And are there any unintentional consequences from that? And the big debate there is whether the inflationary genie pops out of the bottle after 40 years of sleep. Equally, there are still lots and lots of commentators, economists, and very smart people out there who are concerned that debt and deflation are still lasting problems that could potentially suffocate the economy, or at least hold it back, or maybe leave us with a stagflationary return to the 1970s. So I know I've been talking about this with regular viewers for a long time. Inflation, deflation, or stagflation, the battle lines are still drawn. We still don't know what's coming, and to protect client wealth, those are the scenarios for which we have to consider all three potential options, no matter how unexpected they may be. So just to quickly summarise the last 12 months, which have been fast and furious, again from the narrow perspective of financial markets, the broader financial health situation, medical health situation, we'll try and leave to other experts. But again, it has in some ways been tales of the unexpected. Nobody would have said, I think, if I'd sat down here 12 months ago with you and said, in 12 months' time, emerging markets are where you wanted to be, some of the riskier elements of the equity spectrum, I think you'd have certainly raised your eyebrow, if not even curled your upper lip at me, but that's the way in which it's worked out. Developed market equities have done well, commodities have come up on the rails, and what's done badly are the havens to which a lot of people were dashing a year ago, fixed income, in effect. Now, looking at that then from a total return basis in terms of countries, again, you can see who would have thought that Latin America would be top of the pile 12 months ago, when you've still got economic disarray in Argentina and Venezuela. COVID is a massive problem still in Brazil, where there's also political instability. Colombia has just sacked its finance minister after a tax reform bill has gone wrong. So again, nobody would have necessarily expected that. America has been solid. That's perhaps where a lot of people would have felt safest. But again, it's actually now back in the middle of the pack, intriguingly. And again, you can see this by sector. Technology, the only game in town a year ago, has hung in there very, very tough. But materials has jumped to the top of the tree. And we'll come back to this issue of commodities in a second. And what's slipped down again are those haven areas. Perhaps some of the more bond proxy or yield generating areas. Telecoms, utilities, healthcare. They haven't done so well. And again, it would have been a highly unexpected development for us to be predicting a year ago that healthcare would have not been a particularly strongly performing sector. It's clearly doing wonderful things, whether you're Moderna, Pfizer, BioNTech, Johnson & Johnson or AstraZeneca or whatever. But without looking to get into the stock-specific details, ironically, in some cases, the challenge for the sector now is through hopefully helping us get through this pandemic and come out the other side, investors are looking towards things they're going to cyclically recover. So they don't need the safety of pharmaceuticals. At the moment, they're looking for the upturn, the gearing and the leverage into the economic recovery. And that's generally led towards value stocks, even over growth stocks. Jam today stocks over jam tomorrow stocks. And we'll come back to that in a second. And then just looking at fixed income, short duration has provided you with some degree of haven. Long duration has been truly dreadful. And, again, this raises the issue of whether bonds represent, return-free risk, even if, again, you start to see inflation coming up. Corporate bonds, and again, high yield has offered perhaps the most, has been the best place to be in fixed income. Not, again, where you'd have expected us to have been a year ago, but again, high yield tends to perform more like equity. So the better the economic recovery, the more cash flow flows into these companies, the more able they are to service their debts, and therefore the bond prices start to rise on high yields. So total returns, they're very good, with also the compensation of the added coupons. So again, a year ago, I think we'd have all struggled to predict that particular outcome, which again shows how, from a portfolio, strategic or tactical allocation basis, we do need to be prepared for the unexpected and try and cater for a range of outcomes, not just the one that perhaps we think is coming around the corner. And so why have we seen materials come to the fore? Why have we seen commodity exposed markets like Latin America come to the fore? Why have we seen bonds stumble with the exception of high yield? Well, it's this inflation narrative, it's this recovery narrative. Not only are we starting to see the first signs of a strong bounce back, Europe has double dipped because of its fresh first quarter lockdowns, but America's first quarter GDP print was pretty positive. And now the question mark is, well, the Fed is showing, the US Federal Reserve is showing no indication of throttling back on quantitative easing, running at $120 billion a month. It's showing no inclination to raise interest rates from a record low of 0.1%, even though joblessness is coming down, wages are picking up, and there are signs the US economy is coming back strong. So markets are starting to wonder, maybe, just maybe, whether central banks are starting to over-egg it a little bit. You've actually seen rate rises in certain key emerging markets like Brazil and Russia, where central bankers there have begun to flag the dangers of inflation. And markets are responding to it. You can see in the chart here on the left-hand side, money supply growth in the UK and the US. It's not quite off the clock, but it's not a million miles away, and central banks are showing no inclination to try and rein this in. Now, supply of money is not everything. It's supply plus velocity of money that counts. And again, the debate now amongst economists is, well, if everybody starts to emerge from lockdown, those people who've been lucky enough to keep their jobs, not be furloughed, work from home, see their commuting costs go down. Looking at my hometown, adopted hometown of Brighton, people are looking to get out and spend if they're in the position to do so. So maybe you do start to see velocity of money coming through, and that combination of supply plus velocity is when you too tend to start to get inflation, particularly if you have some supply side disruption. And we can see that from silicon chips to shipping to cotton, and you can see it in raw material prices. Iron ore, copper, pretty much at all-time highs. Soybeans and corn at 7-year highs. Palladium at an all-time high. So you are seeing it. So this is why this debate is creeping up. And this is coming through on the chart on the right-hand side with, as I look at it, left-hand side as you look at it, which is producer price indices. So factory gate indices, China, UK, US, America, are creeping up. They're not as high as they were 3 or 4 years ago, but they're creeping up all the same. And that will potentially start to filter through at some stage to corporate buyers and consumers. Those corporates who are seeing increased input costs, they may well at some stage think, actually, we've got to put prices up to preserve margin. And a number of companies have already discussed this. Kimberly-Clark, for example, Procter & Gamble, consumer staples makers. And there was a UK construction materials company last week. The CEO has been in the business for 30 years, and he said he has never seen in his entire career the sort of price increases that he's seeing right now coming into his business. So he's got a decision to make at some stage as whether to start passing that on. So you can see how this inflation narrative is starting to gather pace, and you're seeing it's been starting to reflect in government bond yields, which are creeping up. The UK 10 years now 0.85%. It's not very much, but it's now pretty much back to where it was before the pandemic, for example. And you can see it in equity markets, where, again, growth stocks and growth-oriented funds, technology funds, for example, or some of the classic funds that have done so well for advisors and clients like Scottish Mortgage, they've been phenomenal performers during the pandemic because they've been invested in companies whose business models were perfectly tailored for lockdown and helping people through it, and long-term growth. But the market's now thinking, hang on a minute, they've performed well. They now look potentially quite expensive on price earnings or even discounted cash flow basis, and a lot of their growth is back-end loaded. So you've got expensive back-end loaded future growth. Actually, if there's a strong economic recovery, value stocks, cyclical turnaround stocks have not done as well. They're potentially a lot cheaper, and they could show even more rapid earnings growth in the short term. So cheap jam today is beginning to appeal a little bit more than expensive jam tomorrow, perhaps for obvious reasons. So maybe value and growth are bad terms. Value jam today, growth jam tomorrow. But at the moment, markets, have perhaps potentially switched. And again, this is down the inflation narrative. If you get really strong inflationary growth, you will find cyclical growth in the street for very low multiples, and that's what's clearly catching attentions right now. And in fact, value has almost gone up in a straight line over the last 6 months since Pfizer Monday, intriguingly last November. But as ever, if it was that obvious, well, I wouldn't need to be sat here chirping at you, and we'd probably all be potentially looking around for something else to do. Markets have just had a bit of a rethink because the pace of global economic recovery is clearly not even. The situation in India is frightening. African vaccination supplies look to be dwindling off. The situation in Brazil is still very, very fragile at best, and so there could be an uneven global recovery, even if America has clearly got its act together and the UK has done a pretty good job in terms of vaccine sourcing and the vaccination programme as well, and we're starting to hopefully feel the benefits of that. So again, this talk of an uneven global recovery, with travel restrictions still applying and still some supply side disruption, well, bond yields have just sort of started to top out a little bit, and gold has just started to show some signs of life after about 15 months in the doldrums. So a little bit of a rethink, maybe some havens coming back into play, but again, that's only a month's data. Wouldn't want to read too much into that, but again, it shows you what could happen if something unexpected popped up, like a double dip recession or, heaven forbid, the return of the pandemic. So again, planning for a multiplicity of scenarios is still something that we have to consider, even if at the moment the mood music does seem to be playing a particularly strong inflationary tune. Now, this is a chart that some of you will have seen before from me at the Investival and some of these other multi-asset seminars. It's based on fund management legend Sir John Templeton's epithet that bull markets begin on pessimism, grow on skepticism, mature on optimism, and wither and die on euphoria. And I just find this a useful framework. Because if you thought about it a year ago, there was a heck of a lot of pessimism around, not very much euphoria. And look where we've got to. Risk assets have been fabulous performers, and haven assets haven't been very good at all over the last 12 months. So again, maybe if you are looking for a tactical allocation or a strategic allocation decision, it's rootling round the areas that nobody's interested in, that have done badly, that aren't getting press coverage or are getting negative press coverage, might just be the more fertile territory, rather than giving in to fear of missing out and digging around in the euphoria area where everybody's swimming around. There's oodles of press coverage and pretty much all of it's bullish. And for heaven's sake, don't look at social media, whatever you do, because, or again, if you want to, maybe doing the opposite might be the smart thing to do. So this is a purely personal, subjective view. It's not clear advice, but again, it's just selling. This is based on the number of questions I'm getting in from customers and clients, either be they print or AJ Press or AJ Bell customers and clients. It's based on what I'm reading in blogs and articles and what I'm seeing in terms of performance and valuation. So what's ice cold in Alex right now? What's out with the washing? Well, again, it's still commercial real estate, bricks and mortar retail, and precious metals and miners. Now, bricks and mortar retail may belong out in the cold for a really good reason, but precious metals and miners, if you believe in the inflationary angle, they could be extremely tempting. And again, traditionally during times of stagflation or inflation, real estate is not a bad place to be because you have index-linked rents potentially. Many eddies and whirls there because of the pandemic, but again, a lot of those stocks are trading at big discounts to book value, so there could be some of that bad news already priced in. Now, in terms of skepticism, there's still skepticism over value, whether it's really going to be a sustained, strong pickup. Oil, still profoundly, deeply unpopular, just like tobacco stocks have been for the last 20 years, and it hasn't stopped them performing very well. Optimism, global equities, US equities, no shortage of optimism there. High yield bonds, I'm not saying these are all going to drop in a hole, but there's a lot of good news increasingly priced into them. And then euphoria, well, there are pockets that do feel particularly hot. Cryptocurrencies, special acquisition companies, for example, IPO market getting a little bit hot, even allowing for a flop like Deliveroo. Index proliferation, more ETFs popping out the woodwork, some of them very interesting themes, some of them seem pretty opportunistic to me. So again, just maybe this is a framework for you to think about, draw up your own list of where you think is getting a little bit hot and bothered and where is not so much, and maybe then snuffling out a few funds that may be able to pick out those particular areas that you think may be neglected, may offer value, and may protect you from something that's unexpected coming forwards. Now, just to wrap up then, where we are right now, the prevailing narrative is clearly one of optimism. Vaccinations plus fiscal stimulus plus monetary stimulus. Certainly that's the case for the Western world, for Japan. Again, India, Brazil, slightly clouding the picture for emerging markets, but Asia and Latin American equities overall hanging pretty tough right now, but rates of recovery are uneven. Markets still have faith in central banks, and I think that's going to be a key test going forwards if they do feel that the inflationary target is letting slip. And there is this danger that they're going to overdo it in their determination to see us through the economic downturn in a period when governments have, you could argue, in effect almost bankrupted themselves. So if you do get the inflationary pickup, then history suggests real assets, real stuff, or at least paper claims on them. So miners, precious metals, property have historically done best there, or companies with tremendous pricing power, pretty much anything that you stick down your throat or stick down the sink. So that's maybe where your appointed fund managers, that's a question for you to ask them, are they looking at those areas? If the pandemic lingers, won't go away, or the world just drowns in the debts that it's accumulated, the world goes Japanese. You don't want to be in financials. If history is any guide, you probably do want to be probably a little bit more towards the haven element of things, even a little bit of cash, a little bit of bonds. Nobody knows what's coming. Nobody's got the crystal ball. But if you're looking for a one chart indicator for where it might be, it's this final one here. This just divides the FTSE All World, or the MSCI All World Equity Index, by the Bloomberg Commodity Index. Chart goes up, commodities are outperforming. Chart line goes down, commodities are underperforming. Well, commodities outperformed in the sort of early 2000s, so 10-year outperformance, then 10 years of underperformance. Maybe, just maybe, we could get one of those almost generational shifts, but it wouldn't take inflation to bring it along. But if you start to see producer price indices going up, more companies talking about price increases, and those commodity prices continue to run, maybe, just maybe, we're going to have a major shift from paper assets to real ones in the decade ahead, and that, from where we're standing now, would be a true tale of the unexpected. Thank you very much for your time, and it's been lovely to see you again.